You're watching The Sharpe Angle. I'm Leslie Picker. Software has been one of the worst performing sectors so far this year as the prospect of rate hikes has scared off investors from profitless companies who are unable to model future cash flows way into the future. Orlando Bravo is a founder and managing partner of THOMA Bravo, the largest tech-focused private equity firm with more than $100 billion in assets. Orlando, welcome. Can't wait to dig right in on what's going on in technology right now, because there has been a massive shift in 2022. As I mentioned, there's just this macro change afoot. How does that impact what you do, and what do you make of the recent revaluation in the sector?
Well, Leslie, first of all, thanks so much for having me. It is so good to be here in person with you. This is the first time we do it in person, so once again, thank you for having me. In terms of the changes in the valuations of software, it was just a long time coming. I mean, we've been on a decade of tailwinds, not only in the software industry, but in multiples. And what happened recently is that multiples of these growth stocks went from 20x to 10x. They got cut in half. Now, why is that? Our theme and our thesis on it, talking to the big investors, sovereign wealth funds, big state pension plans, the original sources of capital, is that people are getting tired of big money losing operations. They're finally digging into the business models, looking at when profitability is going to come, and discounting assets that have high growth but no near-term prospects for profitability. So that correction is here, and it's happened, and it's in effect today. Now, how does that affect our business? That is phenomenal on the buy side for our business, because we are focused on buying the entire company, not in buying pieces of paper where you're dependent on what others think. So it gives us an opportunity to do the one thing that we do really well and focus on, which is to take these high growth, innovative companies and put together an operating framework that allows them to be profitable as well and create profitable growth engines.
Would you say at this point in time that the sell-off is really priced in, or do you think that valuations still have further to go before they're at their intrinsic value in your estimation?
As a business owner and as a participant in the private equity industry, it's looking extremely attractive for groups like us. Because once again, you can partner with companies and change their operational makeup by inspiring leadership. And these assets can produce big cash flow, not 20% EBITDA margins, but 50 at growth and scale. So if you can price in your improvements, it looks extremely attractive. Now, for the public markets, the problem is that, once again, you don't have control. So what is the bottom price on a revenue multiple when you're unprofitable, especially when you miss your numbers? And now even more so, if companies don't beat and raise enough to surprise the street positively, and they don't have profitability to hold up your valuation, they are usually getting big negative surprises in terms of their share price.
What does that tell you in terms of exits, though? Obviously, on the buy side, you mentioned tremendous opportunity, but what about the portfolio companies? And you've been a massive deal maker over the past few years, one of the most prolific deal makers over the past few years, in all of private equity, not just tech. But what does that mean for the portfolio companies that you're holding right now? Do you kind of wait a while for things to settle down before you look to do an IPO or to sell it? Or are you still seeing opportunities out there?
That's such an insightful question, because what we do is we buy multiples of revenue, but we sell them at multiples of EBITDA. So we're a fundamental seller as well. And that's how we model our investment cases in our companies. So if you have high cash flow and you don't get the right multiple on that cash flow, you can wait, because you're going to keep adding equity value and you're going to keep building a balance sheet that you can use for add-on acquisitions. We are really not dependent on a market that we call buy high and sell higher. We're not in the momentum business, we're in the fundamental business. What we're seeing in private equity is private equity has not slowed down yet in terms of buying companies on an EBITDA basis. And strategic buyers are sitting on a lot of cash. And when they can buy the number one player in a given sector in software, and that company does not have to be fixed, it does not have to be turned around, it's highly profitable and can operate even as an independent business unit, that is still attractive to these corporate buyers. The IPO is certainly a problem. And if you look at our industry, one of the challenges of private equity that the community doesn't really talk about too much is, remember, private equity needs to buy these public companies at a premium, call it 30% premium. And then you're taking them public at a discount to the comps, call it a 20% discount. So the value that you have to create in between has to be so large for you to make your investment case work if you're planning on taking them public later.
So if I'm understanding this correctly, then you are very hyper-focused once you acquire a company on ensuring that it becomes profitable before you exit, or at least close to that level of profitability before you do seek to exit. How do you do that, especially in this current environment with inflation and all sorts of labor issues in terms of acquiring and maintaining talent? It seems like it would be a tough job right now.
I really appreciate that. We feel like we earn it. And when you own a whole company, which is what we do, you own all the problems. You can't outsource the problems. People change their minds. People want to change jobs. You need to inspire leadership. Customers change their point of view. Their product problems, their sales problems, distribution problems. We live those every single day. The way we do it in a unique way in private equity and in software, which is we make big positive changes in the companies we buy, but we look to do that only with the existing management team. And that's the secret sauce of our firm. And that is, it's more than just the thousands of metrics that we have to bring to bear, the processes that we bring to bear, the great operating partners that we have in our team, our experience in doing this 300 times. More important than all that, because some of those things can be copied, is our culture at Thoma Bravo. And we have a culture that is open-minded and collaborative. So we have a way of talking to leaders and inspiring them to continue to do the great innovative things that they're doing that are going very well, and not interrupt the growth curves of these companies while implementing an approach of discipline and operational cadence that allows that company or those businesses to produce more margin while they grow faster. We are different than most of the world. We do not subscribe to the view that in order to grow, you need to lose money or invest negatively in your P&L. These companies, once you have over $100 million of ARR, annual recurring revenue, the more profitable you are, the faster you should grow, because you have more money built in from your operation to invest in sales, which is tactical, and more money to invest in R&D, which is more long-term and strategic. And we really work with our leaders to put this motion in place and understand it and embrace it so that they can build these long-term profitable engines. And what that does is it de-risks innovation. That way the companies can continue to innovate for a long period of time without having big disruptions to their business models. Or if capital dries up, they're not dependent on outside capital to continue to grow their business.
So the mantra, growth at all costs, do you think that's not the way the world is right now?
That is over. Growth at all costs has ended. And whoever is still investing and operating in this way is going to be surprised. It's changed, and it finally has come after a long period of time of just investing behind a total available market and around momentum growth. People are now finally looking at the business economics. And think about it, it's so basic. How could you create a company and a large company over time where the societal resources that you use for production way exceed the output? It cannot last. And that's a bit of a structural problem the software industry has now, and groups like us look to fix that.
Are you surprised that it took a rising interest rate environment and geopolitical tensions overseas to make that more a part of the conversation? Because it felt like for a while there that growth at all costs was just going to be the way it is forever, and this is just the new Silicon Valley, and if you're not on board, then you're going to lose a bunch of money.
I am surprised. Back in 2013, my partners and I would get together seeing these valuations, and we were thinking, how low of a yield is a buyer of the security willing to accept day one? 5%, 3%, 2%, then it went negative and more negative. And it all got pushed out to the terminal value, appreciation of the asset. That's a risky way to invest. Instead of making some of your money today and even most of your money tomorrow or at the exit. And we are surprised, and it took a long time, but usually it comes with an external shock. And then people become more disciplined, and they have to hang on to fundamentals.
Let's talk about the latter of those external shocks, which is the geopolitical situation in Russia and Ukraine. How does that affect the technology sector? Are you seeing a value that technology can provide, as we assess what's going on overseas?
Well, first, I am surprised that given the geopolitical environment and the invasion of the Ukraine, that the market has not taken a bigger hit. It's almost like the market is pricing, the market is saying status quo, that's an isolated issue, and we'll leave it at that. Because this could have really big repercussions to the economy and to the whole world. So I'm surprised at that. It's almost like I wake up anxiously looking at the futures market and seeing what it is telling us from that perspective. The world has become digital. And that is now, talking about technology, that is an irreversible trend. And we are at the beginning of that trend. In the last 2 years, when we all had to work from home, when companies needed to do business differently, communicate with their customers differently, transact differently, people began, business leaders and society as a whole, began to use technology that has existed for a long time, but their minds were opened to actually absorb that technology and use it differently. And that created another step function in the world of quote unquote going digital. Now you see industrial companies trying to go digital, either acquiring it or changing their businesses, financial institutions. Some of them call themselves a technology company with a financial services business model. And that is the trend. Therefore, the world is a lot more exposed to cybersecurity risks. And now we are, and yesterday some news came out starting to talk about it, that we're also in a technology war. And the importance of cybersecurity as the world goes digital, and especially now, given the geopolitical environment, and in essence a war, the importance of cybersecurity is huge. And yesterday you saw some stocks in cyber companies go up about 10%, because the world is more attuned to that.
You own a plethora of cybersecurity companies. You do have a good sense of kind of the pulse of the technology, as well as the premium that investors are paying here for these types of assets, especially as their value add becomes ever more present. What would you say about just the ability to defend our organizations here in the U.S. and in the West against foreign actors that may be seeking to harm, whether it's banks or other entities here, our defense organizations here in the U.S.?
We have a point of view on that. Thoma Bravo has been in cybersecurity since 2008. We were the first private equity group from a control standpoint to develop a large portfolio in cybersecurity. And today we have $6 billion in revenue if you put all of our cybersecurity companies together, which make us in total the largest cybersecurity company in the world. One of the things we saw is 3 months before the invasion, a huge spike in DDoS attacks, denials of service, mainly coming from Russia. And of course now you see a 10x increase in DDoS attacks emanating from Russia. These attacks are at scale, they are complicated, and even the best cybersecurity technology experts in the US don't quite know how they pull them off at this scale. So it is so important now that corporations all over the world, and especially in the United States, have a strong, what we call cybersecurity posture, which is difficult to have because it requires a big investment. It requires pulling a number of products together. And it's also really important that these corporations of any size, you can be a large company or you can be a very small company, buy the best product in each cybersecurity area. Do not buy free product. Free product is worth what it is. It's free. And that is what it's meant to be. You do not want to be in a bad cybersecurity posture when you did not invest in your infrastructure appropriately.
I also, lastly, just want to ask you quickly about crypto, because you've been a huge fan, a big follower of Bitcoin and other areas of crypto. The cryptocurrencies have gone up as this conflict ensues, as people look at alternative means to transact and see crypto as a potential currency amid these sanctions. What's your view on that? Do you think that crypto holds a place in keeping the world interconnected despite sanctions that are put in place that are aimed at preventing aggressive actors such as Russia from being able to transact with the rest of the world?
I think it's a lot deeper than that. I think crypto holds such an important place in the movement that it is. A movement about young people, non-controlled by centralized organizations, peer-to-peer, not a lot of intermediaries in between. And you have some of the smartest, youngest people developing a new financial system that is decentralized, that is peer-to-peer, and within that financial system, they're dreaming up new use cases and business models. And that is awesome. That is really good. And sometimes I get the question of, well, aren't those use cases available using database technology or using what we're used to? They are. But the fact that they're building this ecosystem makes them a lot more creative. For example, the other day I was talking to a young crypto entrepreneur, and they're developing a way that hourly workers, restaurant workers, construction workers, can get paid by the minute that they work. That way, when the restaurant unfortunately goes out of business, or when something changes, that they don't get paid, or a construction worker, the construction stops, the subs don't get paid, the person is getting paid immediately, and that way also people don't have to live paycheck to paycheck. See, that's an awesome use case. And where did that come from? This new financial world that people are building and dreaming up. And that is irreversible. And Bitcoin, you can argue, oh, it's not a great way to transact because it's volatile. Sure it is, sure that's right, but it is the underpinnings of that whole system. It's the form of collateral, exactly.
Yeah. Well, I think that sounds promising, the idea of getting paid by the minute. I can definitely see that use case. Orlando Bravo, thank you so much for a wide-ranging conversation, technology, geopolitics, inflation, cryptocurrency. You can talk about it all. We really appreciate it.
Thank you so much.